I have spent my life dealing in numbers, not in the abstract sense of pure mathematics, but in the applied, often brutal reality of the financial markets. And if there is one constant truth I have observed, it is this: most people fundamentally misunderstand the mathematics of wealth. They look at a table, a simple linear progression of net worth by age, and they feel either a misplaced sense of security or, more often, a paralyzing anxiety. They compare their current position to an arbitrary, often misleading average. They are looking at the wrong metric through the wrong lens, and they are missing the single most important reality of long-term financial success. The reality no one talks about is that wealth accumulation is not a linear function. It is not a straight line from point A to point B. It is an exponential curve, governed by the relentless, unemotional force of compounding. And the consequence of this mathematical truth is that for the first decade, perhaps even two, the progress is imperceptible. It is a period of quiet, disciplined accumulation that feels like a failure. But it is precisely this slow initial phase that determines the magnitude of the final result. To succeed, you must learn to ignore the noise of comparison and embrace the cold, hard logic of the exponential function. I am not here to offer you a feel-good message. I am here to offer you a framework for thinking, a mathematical model for your financial life. We will dissect the misleading nature of average net worth, expose the fatal flaw in the linear mindset, and establish the three quantitative principles required to harness the power of compounding. This is not about luck. This is about process. This is about applying the same rigorous, systematic thinking that we use to decode the markets to the construction of your own financial future. Let us begin with the illusion of linearity. The human mind is predisposed to linear thinking. We expect that if we work twice as hard, we will achieve twice the result. If we save twice as much, our wealth will grow twice as fast. This is a comforting, but ultimately false model of reality. In the early stages of wealth building, your net worth is dominated by your contributions, your savings, your income. The returns generated by your capital are a negligible factor. This is the period of the grind, the period where effort feels disproportionate to reward. Imagine two individuals, both starting at age 25. One is a disciplined saver, consistently putting away a significant percentage of their income. The other is a high earner, but a sporadic saver, relying on bursts of large investments. In the first 10 years, the difference in their net worth is largely a function of their total contributions. The compounding effect, the true engine of wealth, is still in its infancy. It is a mathematical whisper, easily drowned out by the noise of monthly expenses and annual bonuses. This is where most people lose patience. They see the slow growth, they compare themselves to the high earner, and they conclude that their disciplined, systematic approach is failing. They abandon the system, seeking a faster, more linear path, a path that inevitably leads to speculation and ruin. The reality is that the exponential curve is a test of patience. The first doubling of your capital takes the longest. But once you have achieved that first doubling, the second doubling takes half the time, and the third half of that. This is the mathematical mechanism of compounding, and it is the single most powerful force in the financial universe. Your goal in the early years is not to achieve a high net worth. Your goal is to survive the linear phase, to maintain discipline, and to allow the exponential function to take root. Now, let us address the misleading nature of the metric itself, net worth by age. When you see these tables, you are often presented with the average net worth. The average is a statistically flawed metric for personal finance because it is heavily skewed by outliers, the few individuals with extreme wealth. These outliers pull the average up, creating an unrealistic and demotivating benchmark for the vast majority of the population. A more honest, more mathematically sound metric is the median net worth. The median represents the 50th percentile, the point where half the population is above and half is below. When you compare the average to the median, the true reality of wealth distribution becomes starkly clear. For a household in their mid-42nds, the average net worth might be several $100,000, but the median is often a fraction of that. The average is a narrative designed to sell a dream. The median is the cold, hard data of reality. To base your financial strategy on the average is to base it on a statistical anomaly. It is to chase a ghost. A quantitative investor does not chase ghosts. A quantitative investor defines a realistic, data-driven benchmark based on the median and then focuses on the process required to systematically outperform it. Your goal should not be to match the average, but to understand the mathematical forces that create the average and to position yourself to benefit from them. This brings us to the 3 quantitative principles for building wealth, principles that transcend age and market conditions. Principle 1, systematize your savings rate, not your returns. In the early linear phase of wealth accumulation, the most significant variable you can control is your savings rate. Market returns are a function of external chaotic forces that you cannot predict or influence. Your savings rate is a function of your internal discipline. It is a variable that can be systematized, automated, and optimized. We systematize our trading at Renaissance because it removes emotion and ensures consistency. You must apply the same logic to your personal finances. Automate your savings, treat your contribution rate as a non-negotiable parameter in your financial model. A high, consistent savings rate is the fuel that powers the exponential engine. Without it, the engine stalls, regardless of how high your returns are. Principle 2, embrace the power of the small edge. In the markets, we look for small, statistically significant edges that we can exploit repeatedly. We do not need a massive, once-in-a-lifetime trade. We need thousands of small, profitable trades executed with precision. The same principle applies to your personal finances. You do not need a single massive investment to get rich. You need a portfolio of small, consistent, mathematically sound decisions. This means optimizing for low fees, minimizing taxes, and maintaining a diversified, low-cost portfolio. These are small edges, but when applied systematically over decades, the compounding effect transforms them into a massive advantage. The difference between a 0.5% fee and a 1.5% fee may seem negligible today, but over 40 years, the mathematical drag of that extra 1% will cost you hundreds of thousands of dollars. The market is a game of marginal gains, and the rational investor seeks to eliminate every unnecessary drag on their capital. Principle 3, the time horizon is your ultimate asymmetric advantage. The greatest advantage a young investor possesses is not their intelligence or their income, but their time horizon. Time is the multiplier in the compounding equation. It is the variable that allows the exponential curve to bend upward dramatically. A seasoned investor, like myself, must seek out complex, short-term inefficiencies because the long-term compounding advantage is diminished. You, however, have the luxury of patience. Your time horizon allows you to ignore the daily noise, to weather the inevitable market volatility, and to let the mathematics work its magic. Volatility, which is a risk to the short-term trader, is merely a temporary fluctuation to the long-term investor. Your primary task is to protect this advantage to avoid the emotional, short-term decisions that force you to realize losses and interrupt the compounding process. The common habit that destroys wealth is not a lack of income, but a lack of mathematical discipline. It is the failure to understand the exponential nature of wealth, the pursuit of linear, short-term gains, and the emotional reaction to misleading metrics. To build generational wealth, you must become a quantitative investor in your own life. You must define your system, automate your contributions, eliminate the mathematical drag of fees, and, most importantly, have the patience to survive the slow, linear phase. I urge you to stop comparing your net worth to the average. Instead, compare your process to the principles of sound mathematics. Are you systematizing your savings? Are you optimizing for small, consistent edges? Are you protecting your time horizon? The answers to these questions will determine your financial future. If you have found this discussion valuable, I encourage you to like this video and to share your thoughts in the comments below. Tell me one way you will apply the principles we have discussed today to your own financial system. The journey to financial success is a long one, but it is a journey that is made predictable and profitable by the application of cold, hard logic. Thank you. Let us now delve deeper into the mathematical certainty of the first principle. Systematize your savings rate, not your returns. In the early stages of your financial life, your net worth is an additive function. It is the sum of your contributions. Market returns, which are inherently stochastic, random, and unpredictable, are merely a secondary variable. The equation is simple. Net worth is approximately equal to total contributions plus total returns. When total contributions are large relative to total returns, the most powerful lever you possess is the one you control entirely. Consider the concept of financial inertia. An object at rest tends to stay at rest. A portfolio with a low savings rate tends to stay small. To overcome this inertia, you need a force, and that force is a high automated savings rate. The beauty of a systematized savings rate is its mathematical certainty. Every dollar saved is a dollar earned, a dollar that is not subject to market volatility, a dollar that is immediately put to work as principal. It is a guaranteed return on discipline. We, as quantitative thinkers, value certainty above all else. We build models to predict the unpredictable, but we prefer to operate in the realm of the predictable. Your savings rate is your most predictable, most controllable variable. It is the one parameter in your personal financial model that you can set with absolute confidence. By automating this process, you remove the human element, the emotion, the procrastination, the rationalization that is the enemy of consistency. The decision to save is made once, and the system executes it thousands of times without fail. This is the application of algorithmic discipline to personal finance. The linear phase of wealth accumulation is not a period of failure. It is a period of maximum leverage on your savings rate. A 10% increase in your savings rate at age 25 has a far greater long-term impact than a 10% increase in your investment returns at age 55. Why? Because the increased savings are immediately subjected to the full duration of the compounding curve, you are feeding the exponential engine at its most critical formative stage. The failure to systematize this early is a mathematical error of the highest order, a profound misallocation of effort and focus. Now, let us examine the second principle. Embrace the power of the small edge. In the world of high-frequency trading, we seek edges measured in basis points, hundredths of a percent. These small, fleeting advantages, when executed millions of times, compound into massive profits. The same principle of marginal gains applies to your long-term wealth. The market is a highly efficient machine, and massive, obvious edges are quickly arbitraged away. The sustainable edges are the small, persistent ones that most investors are too lazy or too distracted to pursue. The most insidious drag on long-term wealth is the cost of friction, specifically investment fees. Let us quantify this. Imagine two identical portfolios, both earning an average annual return of 7%. Portfolio A has a total expense ratio of 0.5%. Portfolio B has a total expense ratio of 1.5%. That 1% difference may seem trivial. However, over a 40-year investment horizon, the mathematical reality is brutal. The investor in portfolio B will surrender nearly 28% of their potential final portfolio value to fees. That 1% difference in friction does not result in a 1% difference in outcome. It results in a massive, nonlinear reduction in final wealth. This is the mathematical cost of complacency. A quantitative investor views fees as a guaranteed negative return. Why would you willingly accept a guaranteed negative return when you are striving for an uncertain positive return? The pursuit of the small edge means ruthlessly minimizing all forms of friction, choosing low-cost index funds, optimizing tax efficiency, and avoiding high-commission products. Tax efficiency, in particular, is a form of guaranteed return. Every dollar saved in taxes is a dollar that remains in your portfolio, compounding tax-free. This is a certainty, a known variable, and a rational investor will prioritize it over the uncertain promise of a high-fee, actively managed fund. The small edge is not about finding the next Amazon. It is about eliminating the self-inflicted wounds that sabotage the compounding process. Finally, we turn to the third principle. The time horizon is your ultimate asymmetric advantage. Your greatest asset is not your capital. It is the time you have to deploy it. Time is the most powerful, non-replicable variable in the compounding equation. A long time horizon fundamentally alters the definition of risk. For a short-term trader, volatility, the rapid fluctuation of prices is risk. It can wipe out capital before a statistical edge has time to assert itself. For the long-term investor, volatility is merely noise. It is the random walk of the market, a necessary condition for the long-term upward drift that is driven by global economic growth. Consider the market as a random walk with a slight positive drift. In the short term, the random steps dominate the movement. You cannot predict where the market will be tomorrow or next month. But over a sufficiently long period, the slight positive drift, the long-term expected return, asserts itself with mathematical certainty. The longer your time horizon, the more the signal, the expected return, dominates the noise, the volatility. Your long time horizon gives you an asymmetric advantage over the entire financial industry, which is largely optimized for short-term performance and quarterly results. You have the luxury of patience, the discipline to wait for the mathematical certainty of the long-term drift to assert itself. Your primary task is to protect this advantage from the one entity that can destroy it, your own emotional mind. The market will test your patience. It will create narratives of panic and euphoria, but your system must hold firm. Trust the mathematics, trust the time. The exponential curve is your ally, but only if you give it the decades it requires to work its magic. In summary, the reality of net worth by age is not a simple linear progression. It is a complex, exponential function that is mercilessly unforgiving of emotional decision-making and mathematical complacency. To succeed, you must abandon the linear mindset, ignore the misleading average, and adopt the quantitative principles of the systematic investor. Systematize your savings, ruthlessly eliminate friction, and protect your time horizon. This is the only path to transforming a slow, frustrating start into a powerful generational legacy. Let us consider the psychological toll of the linear mindset. The modern financial world, driven by media and social comparison, is a constant assault on the rational mind. It promotes a culture of instant gratification, where success is measured by the immediate, visible gains of others. This creates a profound psychological disconnect with the mathematical reality of compounding. The linear thinker, seeing the slow, quiet progress of their own systematic savings, feels deprived. They feel they are falling behind. This feeling is the psychological mechanism that drives the fatal shift from investing to speculating. Speculation is the attempt to force a linear outcome onto an exponential process. It is the belief that you can compress decades of compounding into a single high-risk trade, It is the ultimate expression of the emotional mind overriding the rational system. The speculator is not seeking a statistically sound edge. They are seeking a narrative, a story of rapid success that validates their impatience. They are chasing the average, which, as we have established, is a statistical mirage created by the few who were either exceptionally lucky or who had the discipline to survive the linear phase. The true reality of net worth by age is that the most critical phase is the one that is least celebrated, the period from age 20 to 40. This is the period of maximum mathematical pain and maximum psychological pressure. Your net worth will appear stagnant. Your friends who are speculating, who are chasing the latest fad, will appear to be winning. This is the test. This is the crucible where true financial discipline is forged. If you can maintain your system during this period, if you can resist the urge to speculate, you have already won the most important battle. You have proven that you are capable of operating outside the emotional narrative of the market. The philosophical implication of the exponential curve is that it demands a radical redefinition of success. Success in the early years is not measured by the size of your portfolio, but by the integrity of your process. Are you consistently executing your system? Are you maintaining your savings rate? Are you eliminating friction? If the answer to these questions is yes, then your net worth, regardless of its current size, is on the correct trajectory. The exponential curve is a mathematical promise, and mathematics does not lie. Let us further explore the concept of asymmetric advantage inherent in the time horizon. The long-term investor is essentially a counterparty to the short-term emotional trader. Every time the market panics, every time a narrative of fear or greed drives prices away from their fundamental data-driven value, the long-term investor is presented with an opportunity. This is not an opportunity to speculate. It is an opportunity to systematically rebalance, to buy assets at a discount, and to accelerate the compounding process. The short-term trader is playing a zero-sum game against other short-term traders. The long-term systematic investor is playing a positive-sum game against the long-term growth of the global economy, using the short-term emotionality of others as a mechanism for arbitrage. Your long time horizon is the ultimate form of patient capital. It is capital that is not subject to the quarterly pressures of the market, capital that can afford to wait for the mathematical certainty of the long-term drift. To truly embrace this advantage, you must cultivate a profound sense of intellectual detachment. You must view market volatility not as a threat, but as a data point. You must view market narratives not as truth, but as noise. Your emotional response to the market is a variable that must be minimized, if not eliminated entirely. This is the core of the quantitative mindset, the replacement of human judgment with systematic, data-driven execution. I have often been asked, what is the secret to Renaissance's success? It is not a single brilliant algorithm. It is the unwavering commitment to the system, the refusal to override the model, the discipline to trust the mathematics even when the market appears irrational. This is the golden rule of quantitative investing. Never override the computer. You must apply this rule to your own financial life. Your personal financial system, your automated savings, your low-cost diversified portfolio, your long time horizon is your computer. When the market is crashing and your instinct screams to sell, that is the emotional mind attempting to override the system. When a friend tells you about a stock that is guaranteed to double and your instinct screams to buy, that is the emotional mind attempting to override the system. Every time you override your system, you introduce a profound, unquantifiable risk. You are replacing a statistically validated process with a single emotional decision. This is the habit that quietly destroys generational wealth. The reality of net worth by age is not a destination. It is a function of the path taken. The path of the rational investor is one of quiet, consistent, and mathematically sound execution. It is a path that requires patience, discipline, and a profound respect for the power of compounding. It is a path that is ultimately predictable, profitable, and immune to the emotional chaos of the market. I urge you to reflect on your own financial system. Is it robust? Is it automated? Is it immune to your own emotional interference? The answers to these questions are the only true measure of your financial health. If you have found this discussion valuable, I encourage you to like this video and to share your thoughts in the comments below. Tell me one way you will apply the principles we have discussed today to fortify your own financial system. The journey to financial success is a long one, but it is a journey that is made predictable and profitable by the application of cold, hard logic. Thank you. Let us conclude by synthesizing these three principles into what I would call a unified field theory of personal finance. In physics, a unified theory seeks to describe all fundamental forces as part of a single, elegant framework. In finance, this framework is the systematic application of mathematics to the problem of wealth accumulation. The three principles, systematize savings, embrace the small edge, and protect the time horizon, are not independent variables. They are interconnected forces that, when aligned, create an unstoppable momentum. Your systematized savings provide the mass, the principle, the raw material for the engine. The small edge, the ruthless minimization of fees and taxes, acts as the lubricant, eliminating friction and ensuring that every unit of mass is converted efficiently into energy. And the time horizon is the gravity, the nonlinear force that bends the curve of reality, transforming linear effort into exponential result. The failure to achieve generational wealth is often the result of a misalignment of these forces. The emotional investor focuses on the small edge of a single stock pick, but lacks the mass of systematized savings and the gravity of a protected time horizon. The linear thinker has the savings, but allows the small edge to be eroded by friction and interrupts the time horizon with emotional trading. The true quantitative investor understands that the power lies in the alignment. It is the quiet, consistent execution of the system that matters. It is the understanding that the greatest financial risk is not market volatility, but the risk of process failure, the failure to execute the system, the failure to trust the mathematics. The net worth tables you see are a reflection of past process. Your future net worth will be a reflection of your current process. You cannot change the past, but you can, with absolute certainty, change your process today. The decision is a purely rational one. Will you continue to be a subject of the market's emotional chaos, or will you become a master of your own financial system? The choice is yours, and the mathematics is unforgiving. Thank you. The ultimate lesson from the world of quantitative finance is the profound respect for data and the rejection of dogma. We do not operate on theories of how the market should behave. We operate on models of how the market does behave based on empirical evidence. This is the intellectual humility that must define your personal financial journey. Do not adhere to the financial folklore that is passed down through generations, the emotional, anecdotal advice that has no basis in mathematical reality. Test your assumptions. Question the conventional wisdom. If a financial product or strategy cannot be rigorously quantified, if its claims cannot be validated by historical data, then it is not an investment, it is a narrative. And narratives, as we have discussed, are the enemy of wealth. Your net worth is not a measure of your worth as a person, but it is a precise mathematical measure of your financial process. Make that process rational, make it systematic, and make it relentless. This is the only path to true financial freedom.